welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In this episode of the Moneymakers Investment Trust podcast, it's time for me to have another chat with Andrew McHattie, the editor of Investment Trust newsletter, and review some of the interesting things that have been going on in the sector in the last couple of weeks or so. So, welcome back, Andrew. Let's kick off, shall we, by just talking about a little bit of mood music around the market. We've got the budget coming up, obviously, in 13 days' time, a couple of weeks' time as we speak, and that sort of cast a bit of a damper over proceedings, I think it's fair to say, as far as the UK market's concerned. But overall, what do you think has been going on around the world in the markets?
Hi, Jonathan. Nice to be back. You're quite right about the UK budget. It's a bit of a curiosity, really, that a new government should be elected with a huge majority and then spend several months actually chucking ideas into the media to see if they stick and seeming rather uncertain about what they'd like to do on the fiscal front. But anyway, I think you're quite right that actually this has distorted activity in the markets. There are quite a lot of investors are not doing anything. They're just waiting to see exactly what happens with capital gains tax and other taxes. And then on the other hand, you also have people pushing forward some of their activity. And I've heard from private equity managers, for example, that individuals who are selling their businesses are quite desperate to get that done before October 30th. So it's caused quite a lot of distortion, and I think it'll be actually quite refreshing to get that out of the way, and then we can just get on with business as normal and see exactly how the UK is set. And elsewhere, we had this massive stimulus, of course, from the Chinese, which came after the American interest rate cut. And that was quite unexpected, both, I think, in its timing and also its quantum. And that really stimulated Chinese equities quite a lot. So we saw some big gains in the Chinese investment trusts. And that served to enliven things a bit. So it's certainly not been a quiet period.
That's for sure. And of course, we've also got the uncertainty of the US election, which appears to be on a knife edge. We'll find out on the day whether that's actually the case or not. So that's coming up as well in the next 2-3 weeks. So there's certainly a lot to keep people on their toes, let's put it that way. And I think just on one particular segment, I do think your point about what business owners are doing, prompted by fears that there may be changes in the tax regime that affects business property relief or inheritance tax in other forms, and capital gains tax, of course. It hasn't been helpful, and some of the UK's smaller company trusts, which have done very well since a year ago, have actually faltered somewhat in the last month or so. And I guess there's been particular concern about AIM market in that context. However, that, as you say, will all be resolved before too long, so there's not much further point in speculating. I think let's talk about some of the news that we've had out of the sector. Let's start with something which is, I guess, a positive, which is the fact that the Witan Alliance merger has gone through to create a new mega trust, if you like, which I think may qualify for the FTSE 100 in due course. So what are your thoughts on that one?
Well, this is a good place to start because I imagine quite a lot of listeners will hold this trust, either because they held Alliance Trust before or because they had Witan. And this is one of the new behemoths of the sector now. I think it's the 5th largest trust overall. And in the global sector, it's now one of the giants along with Scottish Mortgage Trust and F&C Investment Trust. So it has assets of just over £5 billion, which, as you rightly say, depending on exactly how prices move between now and December, that may well mean it enters the FTSE 100 index. And so I think that's going to help its profile, hopefully encourage a few more investors to come in. And as it is, actually, I think the merger went as well as it possibly could have done for the trust, because there was a chance for a cash exit for Witan shareholders, and that was capped at a maximum of 17.5% of the capital. But actually, only 9.3% of these shareholdings opted for an exit. So the vast majority of assets were transferred into the new trust, and it's all set. There's not too much work involved in merging the two portfolios. And I did notice, actually, that the trust has added one manager, Jennison Associates, who were already managing some of the assets of Witan. So again, that's helped the merger go smoothly. So I think actually now this is a well-placed trust that many people will consider as a good long-term savings vehicle. I think it's a very solid part of our sector.
Indeed it is. And I think just on those numbers, I might, as you say, just refresh people's memory about what the market cap ranking is. We have 3i at the top, way out in front, but that's trading on a huge premium, of course, which inflates that data. Then we've got Scottish Mortgage at around 10.8 billion. Pershing Square Holdings at about 6.7, then F&C, which is now only a fraction ahead of Alliance Witan, and they are then some way ahead of the next largest trust. So do you think that being put into the FTSE 100 will make a significant difference to the rating? I mean, it's striking. I think the new merged entity is on a 5% discount, which is certainly narrower than F&C, which is on an interesting looking 9% discount. Do you think that's going to have an impact?
My experience with these index changes is that they have this short-term noise and a bit of impact on the day, because we've seen F&C actually go in and out of the index quite a few times over the years. So you might see a little bump in the price of Alliance Witan at the time, but I think generally it doesn't make a great deal of difference overall. You'll see a bit of buying from index trackers, of course, but generally it's on a fairly narrow discount anyway, and in the long run it's not going to make a great deal of difference. I think where it helps is just with the profile of the trust, and I think that's good for the sector overall, because I think sometimes the importance of investment trusts to the UK stock market and the UK economy is underestimated. So if you have 3 or 4 trusts that are in the FTSE 100 index, or perhaps 5 actually, then I think, again, that just helps the profile of the sector overall and should encourage investors.
And now, of course, it's up to the managers to justify the faith of the shareholders. The multi-manager approach that Alliance follows, I think, is definitely an interesting and differentiated approach available, certainly to private investors. They're getting effectively an institutional type mandate at a pretty attractive price. But of course, there's no guarantee that the relatively decent performance in the recent years will continue, of course. That's the risk you take on these things.
And it hasn't always worked well. I do remember when Witan first introduced this, they were very much the groundbreakers here, and they started with this multi-manager approach, which always sounded so good. And you're quite right, it sounds like a very sensible, measured approach for a diversified global investment trust. But they didn't actually do that well initially. And I think probably they've refined the process a little bit, and I think in recent years it's been much better. So yes, I think it's okay, actually. I think it does work quite well generally, but there's absolutely no guarantee of that. And undoubtedly there will be periods in the future where Alliance Witan underperforms. That's just the nature of the beast.
I just wonder how far the rating of F&C, which has moved out a little bit towards 9%, which is towards the higher end of its normal range, I wonder how far that's due to the fact that it has wandered into the private equity space. It's got about 10% in private assets, mainly through Pantheon and one other vehicle, I think. Do you think that's been a factor, or is it just this is just normal kind of seasonal or other reason, fluctuations in discount?
My feeling is it's probably other factors. I think because of the high incidence of savers in these trusts, actually probably matters such as demographics are more important. That if you have generally people who are aging and maybe pulling some money out of investment trusts, or perhaps they're worried about the future, they're worried after the change of government and uncertainty around the budget, they might just be pulling a little bit of money out. And I suspect that's more relevant than the shift into private equity, which has been going on for a few years now and actually generally has been a plus, not so much of late, but I'm not sure people would be worried about that. But I think it's a relevant point in the sense that people will undoubtedly be evaluating their savings vehicles going forward. And I think probably Alliance Witan and F&C Investment Trust will be very much in the forefront of their thoughts. So those two are going head to head, I think.
Indeed, and that may well be healthy. Let's move on then, and let's talk about another interesting vehicle that's been in the news recently, not one that we've talked about very often, and that is Tetragon Financial. What can you tell us about that? What have they said, and what in fact do they do?
Well, we really are shifting here from something quite mainstream to something on the very fringes of the investment trust industry. But I think this holds messages, broader messages actually, for us to think about. So it's an interesting trust to talk about. So yes, Tetragon Financial Group, American-based company that actually has holdings in a number of asset management companies, and then also quite a lot of mixed holdings, so rather like a mini hedge fund. But it's quite a large trust, but very much on the fringes of the industry because it has some curiosities. The management are very large holders here. They own about 30% of the trust. They're very wealthy managers. And also the shares basically have very little power. Your vote is meaningless here because actually the managers absolutely have control of this, and they don't have a great track record of considering minority interests. And that's one reason why the shares in Tetragon have historically traded at a very wide discount. And I remember looking at them quite some years ago, actually, when the discount was about 35 or 40%, and absolutely thinking that this couldn't possibly widen from that level. And then it did. And it went out to between 60 and 70%. So a mammoth discount, which is partly because there was no chance of the trust changing and being wound up, but also a bit of uncertainty about how it was being run. And I think this attracted many discount hunters, and many investors have bought this just because of that very wide discount, basically in the hope that at some point something would happen that would bring the discount in. And the shares have been on the move this month, up by a little over 20%, on the basis of a media report that something could be happening now. And we don't know yet whether this is the seismic event we've been waiting for, but it might be. And that's that Reuters have reported that the company might be able to sell a company called Equitix, which is a US asset manager, an infrastructure manager. And this is the trust's largest holding, valued in the books, and this is the interesting part now, valued in the books at $825 million at the end of August. But if we follow the maths through from the Reuters report, then the sale proceeds, if it goes through, could be $1.4 billion. So that's a huge uplift. And that would imply a rough 20% uplift in the overall NAV for Tetragon, which accounts for that rise in the share price. But there's more to this as well, and I'll try to be brief. But there's an option over another asset that Tetragon might sell as well. And if these two deals go through, then the trust could have 40% of its assets in cash. Now, I don't know, I have no clue whether it's going to give some of that capital back to shareholders. If it does, that could be a bumper return, or potentially even there's some existential issues here and the trust could decide that it's reached the end of its life and it's time to think about winding up. I don't know. It might not do those things, but either way, it's an interesting point here, and you might finally see a narrowing of that incredibly wide discount, which would justify the very considerable patience that people have shown.
Indeed. I mean, the discount is still very, very wide anyway, even after the share price move 60% or something, which is extraordinary in a way. But of course, it does tell you how important the structure of investment trusts are. I mean, this is a Guernsey listed trust, and it's basically, if you do invest in it, you're taking, to some extent, a leap in the dark, are you not? You don't quite know what the controlling party will do. And we've seen that with other examples, particularly in US hedge fund type trusts in the past. I think of some of the Gabelli funds and so on. Where they have control, then you have basically little say over it. And certainly, again, history suggests that if you rely on media reports that are unconfirmed, you are also taking a risk there. Let's move on then and talk about something which may or may not be a good news development. Let's talk about what's been happening at Digital 9 Infrastructure. One of the disasters of the recent investment trust space, I think it's fair to say. Got themselves in terrible trouble, overexpanded, had too much debt and so on. But while there's life, there's still opportunities. So what's the news there and what do you think about it, Andrew?
Well, yes, the managers' triple points here absolutely didn't cover themselves in glory, did they? And they've now been replaced by the board, who are appointing infrared capital partners in their stead. This initially looks like great news for shareholders because I think infrared are very highly regarded. They are the current managers of both HEIT Infrastructure and Trig as well, so big infrastructure trusts. And I think if there is a blue chip manager in the sector, infrared are probably the ones. And so they will now oversee the sale process because Digital 9 is basically trying to sell its assets. And I've read quite a lot of comment about this, which is generally pretty positive, although not universally, so I'll come on to that. I think on the positive side, it is known that infrared already know Arqiva, one of the key assets, very well. They're incentivized to maximise the receipts from the sales. And two of the managers, James O'Halloran and Richard Crawford, have each purchased 600,000 shares in the trust. So this is all positive news, and I think shareholders should feel quite encouraged and comforted by that. But I think there is another aspect to this, which is that actually InfraRed are not specialist digital managers, and so you could argue that they don't have quite the right expertise here. Also, as well, the fees that they're charging are fairly substantial. Now, they are incentivised to maximise the realisations once those are over 26 pence per share, which is significantly above the current share price of around 18. But if you put that in the context of the NAV, which is 46.6 pence, it doesn't sound so good trying to get 26. So I don't know. There's a lot to come here, and this story is going to develop some more. But overall, my feeling is that it probably is good news for shareholders.
Right. I mean, the share price has sort of stabilised in the last 6 months, but it's already way, way down. It's, I think, in the 20p range, which compared to the launch price of 100 is not anything to be proud of. But it's funny in these situations where things go really badly wrong. It seems to be that there's a sort of psychological impact that a lot of shareholders, they think, well, it's already gone down 50%, it can't go any further. And then, of course, it does. And we've seen that happen in a couple of cases. So I think that's something to ponder on. Of course, if capital gains tax is going up, this might be a useful way to shield your losses here, would be a good way to shield some tax you might otherwise pay. But, of course, it's interesting also, I think, in the sense that you talk about InfraRed taking over. We've seen a couple of other examples where new managers have been brought in to manage the process after a disaster. So I'm thinking of, AEW came in to try and help sort out HEIT, and Octopus came in to try and sort out what was Thomas Lloyd Energy Impact. And I think by all accounts have done pretty reasonable jobs, but not enough to actually kind of save the trust in the future. So I would guess that the story here is this is all about trying to get InfraRed to get this thing wound up and sold as soon as possible, and hopefully make a little bit of money back for the shareholders. But it's still a pretty sorry story, isn't it? Which I think might be worth investors pondering about what's gone wrong here. Basically, far too much debt, I think, is the short answer, isn't it?
I think that's right. Far too much debt, and actually far too much enthusiasm over a hyped sector, so that I think the managers felt under great pressure to get the money invested very quickly, and they didn't invest it very wisely.
It sounded like a sexy idea, but of course we know that doesn't necessarily guarantee results. Okay, let's talk about something else. Let's talk about another relatively small trust, but this is an interesting one for a different reason, I think, and this is something called Crystal Amber. Not one, again, we've talked about much. It's not on the radar of a lot of people. It's another Guernsey-listed trust. Tell us what's been going on there. What does it do, and what's the news there? Why are we interested in talking about it?
Another peculiar situation, this one, and the reason we're talking about it really is because this is one of the best performers of recent times. The shares are up nearly 70% over the last year, and it's in an interesting position. It's a definite curiosity again. So this is a very concentrated trust. It basically has two holdings now because it's in wind down mode, and it's managed by a well-known activist. And so this trust was very much about buying holdings, sorting them out, putting in new management, selling bits off and realising value. And that's what it's been doing. Now, I've been looking at Crystal Amber for quite a few years, and it's never going to win any awards for its shareholder communications. It's quite difficult to know sometimes what's going on here. But recently, it seems to have been going very well because its two big holdings have both released news. The first one was Morphic Medical, which is an unlisted medical devices company, and that was independently valued in July and resulted in a significant uplift to the NAV here, up to about 170 pence per share, which compares to the current share price of 112.5, so a very significant discount there of about 33%. And then actually in the last couple of weeks we had news from its other big holding, which is a listed company, the banknote printer De La Rue, which has agreed to sell off its authentication division for £300 million, which seems to be a very good price. The shares reacted well, and this opens the door for a potential sale of the rest of the De La Rue business as well. So this was good news for Crystal Amber, and we saw another pop in the share price, although it hasn't really received a lot of follow-through. And I think this is interesting because my sense here is that Crystal Amber is definitely approaching its end game, and yet the discount is still incredibly wide. It's not something that's that easy to deal. It's on a bit of a wide dealing spread. It's a small trust. So again, probably not near the top of the list for many investment trust buyers, but an interesting case if you like those kind of situations.
Yes, and it's fair to say that its performance has been, it's been interesting in a way because its share price performance has been pretty dismal ever since the pandemic, basically. It sort of cratered then and has never come back, essentially. But it has paid quite a decent dividend, or payouts anyway, and so the total return hasn't been that bad. But essentially, it failed a continuation vote, I think, 2 or 3 years ago, and then when it went into a sort of wind-down mode. But as you say, I think it's actually the best performer year to date in the investment trust sector in share price terms. As you say, communication not its strong point. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favourite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Let's talk about redemption opportunities next. This is a mechanism whereby investment trusts offer shareholders the chance at either regular or periodic intervals, the chance to redeem some of their shares at a fixed price. A couple of trusts that are relevant in this context at the moment. Let's talk about the first one, which is the ticker AJOT, the Asset Value Investors Japanese corporate governance play, if I can put it that way. It's called AVI Japanese Opportunities Trust. So what have they said on the redemption front? And perhaps you just explain how redemptions work and whether they're good or bad for shareholders generally.
Yes, we have these two linked stories here that have led me to a particular conclusion, actually. One I've held the view for a while, but this has strengthened it. So let's talk it through. So starting with AJOT, this is a trust I wrote about in my last newsletter, actually, and I think it's a really interesting trust. It's done well. It's targeting structurally discounted, smaller Japanese companies with cash on their balance sheets. AVI are obviously a value investors. And it's a good trust. It's done well, good track record. It trades on a relatively narrow discount, about 5% at the moment, and it's averaged 3.5% over the last year. So it seems to me that everything's in place there. There's a nice status quo. But it's written into the trust details that actually there's a redemption mechanism available for investors. And this is in place in order to manage the discount. So effectively, this is saying that we'll offer you an opportunity to get out at a price close to the net asset value periodically, and that means the discount's never going to get too wide because you know that this opportunity will arise. So that's why it exists. It's to control the discount. And arguably, as I was saying, this trades on a narrow discount. Arguably, that has been successful. So that's the plus point. The negative point is that money flows out each time this happens. And in this case, you're being given the opportunity this month to exit at a 2% discount less costs. And I don't think many people will take that up, actually, because it's not really that important for you to get out at that price when you can sell in the market at a relatively narrow discount. And I think the prospects also look good. But what struck me is that the trust has decided, the board has decided to make this an annual redemption opportunity rather than one every 2 years. So they're pumping up this opportunity, and I just don't think it's necessary. In fact, I think it's counterproductive because this is already a good trust on a narrow discount. And I saw this described actually in a broker's note as good corporate governance. And I don't think it is, actually. I think it's the opposite, because the whole point of an investment trust with its closed-end structure is that it offers you permanent capital and you can be a patient investor. And who knows, if you go through a rough patch and your discount widens out or something happens in the Japanese market that's completely beyond your control, you could find that investors are feeling very negative about your trust when the October redemption date comes around, and you get a big rush for the doors, and then you've got to realise assets from your portfolio you had no intention of selling. So I'm not a big fan of that. And again, it's the idea that you have some kind of fixed rule that the board has to follow regardless of market conditions. I don't think that makes sense.
Right. Well, that's a strong statement. I think you're right in the sense that over a 1 year period in particular, you're battling against sentiment, and you may well find that your trust is, as you say, going from kind of feast to famine on a 1 year view. But let's compare that to what's happened at Bellevue Healthcare, ticker BBH, which, as its name suggests, invests in healthcare stocks. What's the story there?
Here's part two of my argument, Jonathan. Thank you. So this trust does have an annual redemption right, exactly the same as the one proposed for AVI Japan. And generally, this has not caused a very big outflow of assets. But actually, of late, the trust has underperformed a little bit. And there seems to be a bit of negative sentiment around both the sector and the trust. And so this time around, it had redemption requests amounting to more than 36% of its share capital. It was 164 million shares. So it's a massive chunk of the assets are now being sold off. In fact, so much so that the portfolio is now having to be split into a redemption pool and a continuing pool. And so the manager has now got to manage that separate redemption pool so that it can raise the capital to give the money back to shareholders. And this is a lot of money leaving here. The current net assets of the trust amount to about 722 million, which means that £262 million are leaving the trust. Now, that does, in fact, at the moment, still leave it at a reasonable size at 460 million. But if this happens next year or the year after, this trust could find that it's too small to continue. And so, actually, it could effectively have constructed itself with this mechanism out of business. And it's not as though the trust has done that badly. Over a year, its net asset value total return is plus 16%. In fact, if you look across the investment company sector of 276 trusts, this is ranked number 100 over the last year, so it's in the top half. It really hasn't done that badly. Its discount is not particularly wide, it's 8%, and that's not just because of this redemption right occurring now. The discount has not been wider than 12% all year. And there's one more thing. I realise this is quite a long answer, but this is also a quirky trust. It's a quirky trust with a concentrated portfolio, and that does mean that from time to time it will underperform. And so on that basis, I don't think an annual redemption right that may in fact be based on how people are feeling about the trust in the short term, I just don't think that's a sensible structure for it. It seems unsuitable to me.
I suppose you could argue that you could put an annual cap on the amount that's redeemable. That might help to, minimise the extreme volatility. And that might be one way to deal with that. But it wouldn't, of course, change the balance between those who want to buy and those who want to sell. So if there are people who want to redeem but can't, or can't redeem to the extent they want to, that may help the discount to persist. But they are becoming more common, redemptions, are they not? I'm just finishing off the Investment Trusts Handbook. I've been looking at the figures, and it's an alternative to share buybacks, a redemption opportunity. But there have been significant amounts of both this year, record amounts of buybacks and significant amount of redemption opportunities as well. I mean, there are cases where it makes more sense, and I'm thinking here of the microcap trusts. So something like River UK Growth, who I talked to in the last edition of the podcast, they have a fixed redemption process, which works quite well because they don't want to go above a certain scale. But against that, you also have the other trust, Witan Microcap, which looks like it's going to go out of business because it's had to give so much money back. So I guess you could argue there are circumstances where this works well and circumstances where perhaps it doesn't. What do you think about the microcap trust? Do you have a view on those?
Yes, and I agree with you. Those are very sensible because you can't realistically have a micro-cap trust getting too large because you won't be able to invest. So I think that's reasonable. But of course, in that circumstance, the manager knows it's coming, it's part of the structure, and they're well prepared for it. So they're ready to sell assets or to keep liquid assets in the portfolio. I think what perturbs me about this quasi-open ending is that it can come up quite suddenly on a manager and they haven't planned for it. They've optimised their portfolio for long-term investment and then suddenly they've got to sell off a massive chunk. So it's really, I think, just undermining the benefit that we've always enjoyed of the closed-end structure, that managers can take a long-term view because they know they have permanent capital. So yes, I can certainly see whilst there are some specific circumstances where this is reasonable, and I do understand the broader point about controlling the discount, but I just don't like it actually, Jonathan. It doesn't work for me, and I think it can cause real issues for trusts that are actually fundamentally good trusts.
Yeah, well, that's a good point. We'll see if anybody comes back and tells us why they think that's an improvement. I mentioned already talking about UK smaller companies and the potential impact of the UK budget, but we have seen some good annual results from smaller and mid-cap trusts recently. And one of those, which is reported this week, is Mercantile, which is a JP Morgan trust, which invests in both small and mid-cap companies. Their results are pretty impressive, and they're still very bullish about the outlook for UK smaller companies. So what do you make of their latest results?
I think this is a trust that many people will own. I think it's a bit of a go-to trust, actually, for people looking for exposure to UK mid-caps, so they're looking for domestic buyers in the portfolio. And it's a good trust, good long-term track record. I own it, actually. And I was very pleased with the results that came through for the 6 months to the end of July, so basically the first half of this year. The net asset value total return was plus 17.6%, which was ahead of the FTSE All-Share, up 15% over the same period. So reasonable outperformance, and yet the shares here are still on a 12% discount, which seems to me actually a little bit wide for a trust that is a top decile performer over the last year. It's actually been a very good period for UK mid-caps. And the managers are indeed bullish. They have their gearing at 15% now, which is the highest for a decade. So they certainly feel that there's a lot of value in UK small caps. And they're able to use cheap debt as well for that gearing. So I think this should be very beneficial for the trust. I like it. I do notice as well that 3i Group, which we talk about quite a lot as being a spectacular performer, is a top 5 holding here. But it's a good trust, I think, Mercantile. And certainly the first half of this year confirms that it did very well.
Yes, I'm not sure I would describe 3i as a particularly small or mid-cap company, but it's certainly, well, it's worked for them anyway. So we've talked about the UK smaller company sector generally and the concerns there have been in the recent slowing down in performance. But of course, perhaps one should just remind some listeners that gearing is a way to actually express, if you like, your confidence about where we are in the cycle for any particular sector. And some of the other trusts in that sector have also got significant levels of gearing. Some of them have it permanently. Henderson Opportunities Trust would be one that comes to mind. But my experience, I don't know if you agree with this, is that it is quite rare for managers or indeed boards to sanction significantly high levels of gearing in their particular trust. I mean, 15% is quite a chunky number compared to historical experience, is it not?
Historically, there's a range here, and many managers actually work within a range. So they'll have a board-sanctioned range that they're allowed to vary the gearing within. And quite commonly, it's 0 to 20% or 0 to 15%. And then if they want to go above that, then they need to seek board approval. But they do have the potential there to express, as you rightly say, their confidence in the markets by varying that gearing level. And so it's quite a useful indicator for us investment trust watchers. And clearly managers can get it wrong as much as anybody else, but it's quite nice to know when they're feeling bullish and they feel there's extra value in their markets. And in this case, this is very much at the top end of the range. So I think it is a bullish indicator. And it's worthwhile looking across the sector to see if other managers apparently share that view.
Indeed it is. Let's talk then about another specialist trust, which is one that I have to say that I own, and I think you may well do too, and that is Literacy Capital, ticker Book, which is an interesting private equity vehicle in the sense that it has a charitable purpose as well as making money for its shareholders. It looks to support literacy by making a small percentage of its return available to support charities in that area. But it's also done very well since it came to the market a few years ago. And they've made an interesting announcement this week, and perhaps you could explain to us how that one works.
This has been a very successful trust, and I'd like to make sure I make that point to preface my remarks here. And I followed it since launch. I've spoken to the managers quite frequently, and you're right, I do own a few shares in this. Now, it's managed by the Pindar family. So Richard Pindar is the manager, Paul Pindar is the chairman. He's behind it as well. He has a big shareholding. And actually, it's really constructed as a family office type business. So although it's private equity, it's a bit different from other private equity managers. And I think the managers have always prided themselves on this. When I've been talking to them, they've always spoken very much about how they're different from the typical private equity manager. They tend to be characterized as ruthless capitalists with, lots of carried interest and high fees. And in the case of Literacy Capital, the managers have always said, well, we're being rewarded through our shareholdings primarily rather than the fees. and the fees were low. And their shareholdings are very significant here. So the Pindar family own more than 40% of the shares here. So they're certainly very significant shareholders. They have a lot of skin in the game. And their management fee was 0.9% of assets on an annual basis, which was relatively low. And they also donated 0.9% of assets to their literacy charities, which is a wonderful thing. However, this has just changed, and I must say I'm a bit disappointed. This was a very unwelcome surprise for me that the board has raised that management fee from 0.9% to 1.5%, and they're reducing their charitable donations from 0.9% to 0.5%. So that's good news for the managers, but I can't see how that's good news for anybody else involved with this trust, and I'm a bit disappointed. I do understand that as the trust grows, it has to take on more resources, and the managers have costs, and those costs are rising, so they have to be paid. But I always very much liked that aspect of the trust, that this was very much differentiated from the rest of the pack. And I'm a bit disappointed now that it's lost one of those major points of differentiation. Or perhaps it hasn't lost it completely, because the managers are still not using carried interest. And I'm sure they would argue that they're still cheaper than the majority of managers in the sector. Nevertheless, this was unwelcome news from my perspective.
Yes, I think what the company said in the announcement, or what the board said in the announcement, was that in absolute returns, the charitable contributions, they have risen substantially because the market value of the company has risen. And they also do need to invest in more resources, you say. I see they've appointed a finance director. I think because my impression has always been that they have run a very, very tight ship. There are only a very small number of people involved in that because it is, as you say, a family enterprise. The market has noticed they've traditionally traded either at a premium or very close to par, apart from one period when they moved out in line with everybody else. But the discount has widened on this one, has it not?
It has, and it could just be that this was news that perturbed a few holders. I think the shares are very tightly held, actually, so you don't need very much trade to move the price here. And generally, I do understand that point about commercialisation, and as you grow, of course, you do have to make sure you're on a reasonable footing that you can sustain going forward. It's just that I always very much admired the fact that this point of differentiation was one the managers were holding on to very strongly, I felt. So I didn't see this news coming.
Right. But you haven't sold your shares anyway.
I haven't sold them, but I haven't added either. I need that discount to get a bit wider first, I think.
Okay, so finally, Andrew, we've covered a wide range of things in this edition of the podcast. Let's just throw in, if we can, the battery storage sector, which has been, again, a bit of a disaster this year. We don't like to focus on disasters, but there's no doubt that has been, if you like, the worst sub-segment of the investment trust universe this year. Lots of problems around revenue projections. But the trusts are trying to fight back by announcing various things concerning future income and, therefore, by implication, potentially dividend cover. So what have we learned this week about the battery storage trusts?
This is an ongoing situation, isn't it? And actually, I spoke to a very knowledgeable private investor yesterday and had a chat about this sector. And he was very perplexed, actually, by the size of the discounts that are still reigning here. Very close to 50%. I mean, they're enormous discounts, which are really indicating that the sector's in big, big trouble. And of course, it has been very disappointing because of the difficulty of maintaining the power prices in the UK, and there's been difficulty with access to the grid and so forth. So the revenues have dropped off, but nevertheless, I do have faith, long-term faith, that actually these batteries are needed, and so we'll have to find some commercial basis for them going forward. And in the meantime, these trusts are developing rapidly and pumping out a lot of news, and we've had two sets of news actually this week. One was from Gore Street Energy, which is slightly different because it has an international portfolio, and it had some quite good news actually from its Californian asset, which is quite a big one, and it's coming on stream actually this year. And this has secured a new 12-year fixed price contract actually funded by Goldman Sachs. And this means actually that a significant chunk of the revenue from this asset, probably around 40% of its revenue on a long-term basis, is known in advance. So this actually really helps the revenue visibility. And that's something I think investors value quite highly. So although this trust is on a 48% discount, actually its shares have risen by 6% today, just as we're recording this, on this news. And I think it's very welcome that actually if investors can see forward and see the revenue coming, then they're going to have more confidence in the outlook and hopefully reduce that discount. On the other end of the spectrum, perhaps we have Harmony Energy, which is actively seeking offers for parts of its portfolio, or maybe indeed the whole thing. And this has been ongoing for a while. So for most of this year, actually, we've known this is what it's up to. It's appointed JLL to seek offers, and it's just provided an update which says that it is encouraged by the level of interest, both for individual assets and, importantly, for the whole portfolio. And they expect negotiations to be concluded by the end of this calendar year. And these things do take some time, but I'm intrigued by this one, Jonathan. I really am, because the share price is around 50 pence. The last net asset value was about 95 pence. So you've got a huge discount of around 48%. And yet the trust is saying it's got very good interest in its assets, possibly for the whole portfolio. So obviously the market just doesn't believe that. It's completely sceptical about the value that might be released here. And of course, you don't need the whole of that value to be released to do very well from the shares. You don't need to get 95 pence a share. I mean, if you get 75 pence a share, which is a fairly chunky discount to that, then you're still getting a 50% uplift on the current share price. So I'm a bit perplexed, actually, that the share price hasn't reacted to this news. Clearly, the market just doesn't believe it.
Yes. Well, I guess there's still a lot of probably bad feeling out there about it, because if you come to the market promising, a hefty dividend and then you basically cut the dividend to zero, which had been the case in two of these three battery storage trusts, it takes some time to get people's confidence back again, because it turns out that the dividend stream has not actually turned out to be secure, which is what you naturally assume when these things were first launched. And we also had the case of one of the trusts. They changed their valuers and they marked down the valuation by 15 or 16%, I think. So there's been a lot of shocks that the shareholders have had to absorb. Maybe they're just a bit too battle-weary to want to look at these things again. But it is interesting. I mean, we'll obviously be interested to see if that announcement about all that interest and the prices at which that interest has been offered, that could, as you say, lead to a significant re-rating across this important but battered segment. That's
a good point you make, actually, Jonathan, that, of course, these were owned by income-oriented investors, weren't they? And now, of course, with Harmony Energy, what we're saying is that this could be of interest to speculative investors looking for a capital gain. So they're a different class, a different category of investor, and maybe those haven't been attracted yet. If Harmony Energy can achieve some good prices for its assets, and that is, of course, a very big if, then it could improve the rating across the sector.
Indeed. But of course, the structural issues around the UK, in particular battery storage, the issues of connectivity and so on, do remain, and they need to be, I think, addressed. That will be something also to look out for. So that brings us to the end of this episode of the podcast. I want to thank you, Andrew, for your contributions, as always. And perhaps it might be worth ending on the note, it happens to be front of mind for me at the moment, because I just said I'm finishing off this year's edition of the Investment Trusts Handbook, that actually overall it's been a very good 12 months for investment trusts in absolute terms. 80% of the trusts have produced positive returns over the last 12 months, which is good. A lot of them have outperformed a falling rate of inflation to deliver strong real returns. So it has been a good period, but of course every year is different, and as we look forward, we've got to get through the budget, the election, the geopolitical situation and so on. There's always these things to worry about. But my sense would be that I don't know if you would agree with this, that overall the sector is healthier than it was a year ago. It has recovered meaningfully.
I like your statistical overview, actually, Jonathan. I think that really helps, because it's very important to remember the context, isn't it? We can get bogged down, actually, in this news flow, which is sometimes a little bit negative. And you forget, actually, that the vast majority of trusts are just quietly getting on with their business, delivering decent returns. And, of course, we have seen a lot of activity in the sector, a lot of corporate activity, which is getting rid of some of these terrible underperformers and these bad situations. And hopefully it does come out leaner, fitter and stronger. We'd all like that, wouldn't we?
We would indeed. So that was Andrew McHattie, the editor of the Investment Trust newsletter, talking to me, as he does regularly, about recent developments in the investment trust sector.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.